The market just handed us a masterclass in human psychology disguised as a Santa Claus rally. While most traders were distracted by holiday sentiment and thin volume, something far more revealing was happening beneath the surface. The S&P 500 gained 1.4% during the week between Christmas and New Year, not through panic buying or FOMO, but through measured accumulation when institutional capital had stepped away. This is exploitable because it reveals the difference between structural conviction and emotional noise. Here's what separates disciplined observers from the crowd. We recognize that holiday trading patterns expose true market character. Today, I'm going to show you 3 critical insights from this past week that reveal exactly how human irrationality creates systematic opportunities. First, why consumer sentiment crashed while GDP soared, and what this divergence means for your positioning. Second, how the CAPE ratio hitting .com bubble levels is actually different this time, and why that matters. And third, the sector rotation that's happening right now that most people are completely missing. Let's get into it. The first insight is about cognitive dissonance at a macro level. Consumer confidence fell to 89.1 in December, while GDP growth was revised up to 4.3%, significantly above the 3.2% consensus. Think about this for a moment. The economy is accelerating, but people feel worse about it. This is the human brain in action. We weight recent emotional experiences more heavily than aggregate data. Those April tariff announcements, still echoing in sentiment surveys months later, even as AI infrastructure spending added 1.1% to GDP growth in the first half of 2025. The system rewards those who recognize this pattern. When sentiment diverges from fundamentals, price discovery becomes inefficient. The crowd trades feelings while data tells a different story. Participants anchored to survey responses miss the underlying mechanism. Capital flows toward productivity gains regardless of how consumers feel about their prospects. This creates opportunities in sectors benefiting from economic acceleration that haven't been bid up by sentiment-driven flows. The Stoic approach here is straightforward. Weight objective measures over subjective assessments. GDP, employment, corporate earnings. These matter more than confidence surveys that lag reality by months. This doesn't mean ignoring sentiment entirely, but understanding its proper place in the hierarchy of information. Sentiment drives short-term volatility. Fundamentals drive long-term returns. Second insight, the CAPE ratio at 39.4 has everyone screaming .com bubble comparisons. Lazy analysis. Almost embarrassing, really. Yes, valuations are elevated, I'm not denying that. But the mechanism driving them differs fundamentally from 1999. The .com era featured revenue multiples on companies with no path to profitability, pure speculation dressed up as innovation. Today's environment features earnings growth supported by measurable productivity gains. AI infrastructure spending isn't a narrative play. It's contributing over 1% to GDP growth through actual capital deployment. The system is pricing in a structural shift in corporate profitability, not multiple expansion, divorced from fundamentals. This distinction changes everything about how these valuations decay. Productivity-driven multiples compress slowly through earnings growth. Speculation-driven multiples collapse through price. The disciplined response isn't panic, it's precision. Elevated valuations warrant caution but not abandonment. Ensure your holdings are concentrated in companies with genuine earnings power rather than speculative narratives. The risk exists, but it's not identical to 2000, and your response shouldn't be either. Third insight, and this is where it gets interesting. Sector rotation is happening right now while everyone's still fixated on technology. Financials, industrials, and materials led the week's gains. The financial select sector SPDR rose 0.9% while consumer staples fell 1.1%. This isn't random, it's game theoretic repositioning. After a year dominated by AI infrastructure plays, sophisticated actors are pricing in second-order effects. They recognize that the build-out phase creates opportunities in adjacent sectors that benefit from economic acceleration without carrying the valuation premium of primary beneficiaries. This isn't abandonment of the AI thesis, it's strategic diversification into less crowded expressions of the same macro force. The system is distributing risk across a wider base rather than concentrating it in mega-cap technology names. When leadership narrows, corrections cascade through correlated selling. When leadership broadens, corrections become sector-specific rather than market-wide events. The human element driving this rotation? Fear of concentration risk, finally overcoming greed for maximum exposure to the hottest theme. Now here's where most people get this wrong. They see gold up 70% alongside equity strength and think the system is broken. Gold hit 54 record closes this year. Silver notched all-time highs. This violates traditional risk-on, risk-off frameworks, and it's exposing the inadequacy of binary thinking. Participants are simultaneously hedging systemic uncertainty while expressing confidence in growth assets. This dual positioning reflects sophisticated portfolio construction, not confusion. The behavior signals that capital isn't fleeing risk, but redistributing across multiple expressions of value preservation and appreciation. The human element here is the rejection of false dichotomies in favor of nuanced allocation. The Stoic framework embraces apparent contradictions when they reflect genuine diversification. A portfolio can hold growth equities, precious metals, and selective fixed income without contradiction if each serves a distinct purpose. The traditional 60/40th assumption of negative correlation between risk assets and safe havens, while the current environment is teaching us that multiple forces can coexist. Let me tie this together with what's happening in the Fed expectations. Rate cut odds collapsed from aggressive easing expectations to sub 15% probability for January. The market spent months conditioning itself for a dovish pivot, but strong GDP and elevated core PCE forced recalibration. The psychological cost of this adjustment manifested in November's volatility, yet the market absorbed it without breaking structure. This resilience indicates the rally was never purely rate-dependent, but fundamentally driven by earnings growth and productivity expansion. The system has been tested repeatedly throughout 2025. April tariff shock, AI bubble fears, Fed policy uncertainty, and each time it absorbed the stress without collapsing. This anti-fragility isn't a guarantee of future performance, but it's an indication that market structure is robust. The disciplined framework here is maintaining flexibility rather than anchoring to a single scenario. Don't predict the Fed's path, position for a range of outcomes. Hold assets that perform across multiple rate environments rather than making concentrated bets on a single trajectory. Finally, let's talk about what this thin volume holiday trading actually revealed. NYSE volume was roughly half the average daily amount, yet the S&P 500 touched an intraday all-time high of 6,945.77. The VIX held at 14 throughout this move. This is orderly appreciation, not speculative fever. When institutional capital steps away and the market still advances, it reveals participants with genuine conviction rather than momentum-chasing behavior. The behavioral signature of this period shows actors who chose to remain engaged despite thin liquidity, signaling confidence rather than desperation. This is the psychology of structural belief, not speculative mania. The Stoic observer recognizes that 1.4% weekly gains on half-normal volume aren't mandates for aggressive action, but confirmation that existing trends remain intact. The appropriate response isn't chasing momentum, but maintaining exposure to structural themes while avoiding the temptation to extrapolate short-term moves. Here's the synthesis. Markets are exploitable because human beings consistently weight emotion over data, trade narratives over fundamentals, and anchor to single scenarios instead of maintaining flexibility. The past week revealed all three patterns simultaneously: sentiment lagging reality, valuation fears overriding earnings growth, and positioning based on outdated correlations. The system rewards those who recognize these patterns and respond with discipline rather than emotion. Consumer sentiment will eventually catch up to GDP reality. Valuations will compress through earnings growth rather than price collapse if the productivity gains are real. Sector rotation will continue as participants seek diversification away from concentrated positions. The crowd reacts emotionally to each data point. We remain disciplined in our process, recognizing that consistency over time matters more than optimization for short-term patterns. This is how you exploit the predictable irrationality of markets while maintaining the emotional neutrality required for long-term success. If you value systematic thinking over emotional reactions to market noise, hit that subscribe button. The link in the description contains the complete framework for identifying these behavioral patterns before they become obvious to everyone else. Because by the time the crowd recognizes the pattern, the opportunity has already moved to those who saw it coming.